all of you for finding us, signing on, taking advantage of the information and the opportunity we're providing for you to get information about the tax aspects of your wildfire losses and some strategies for making those financial decisions about replacing your assets. My name is Amy Bach, and I'm so pleased to be joined this evening by our special guests, our CPA expert. I'm going to introduce you to in a minute. So a little bit about our organization. If you were on last week's webinar, then you already know all this. So I'm going to go through it very quickly. United Policyholders has been a trusted information resource and a respected voice for insurance consumers in all 50 states since 1991. So we are in our 30th year of service. Our focus is on disaster recovery and helping people navigate the road to recovery after a catastrophic loss and make good decisions related to their personal finances and insurance and feel supported. That is the main focus of our program. We're funded by donations and grants. We say we're not for profit, not for sale, because we don't accept funding from insurance companies, so we can have an independent voice and give you information that's in your best interests. And we don't sell anything. You can't pay us. We are here to give you support and good information because we are consumer advocates. So our team includes professional staff, Carrie Waite, who's here with us this evening, Val Brown, who you can't see but is with us as well, Carolyn Winter, who's helping on logistics, and the rest of my team. We also have government and nonprofit partners that are very important. And in Colorado, we have the counties that were impacted by last year's fires that are our partners, Boulder County, Grand County, Larimer County, all helping us provide up-to-date, accurate information to you through our Roadmap to Recovery program. We also have volunteers. Our Survivor to Survivor program is it's not really a program, it's a service that we offer where you can log on and communicate with other people in your situation now, or people who've been there, done that, previous catastrophic loss victims, survivors who help in the conversation. And I will have a slide towards the end that tells you when our next one is. But those are great forums for bouncing ideas around with other people, things that you're thinking about doing in, with your own situation. So we also have consumer-oriented professionals like John Trapani, who is our expert tonight. And he kind of is in both categories. He actually is himself a previous catastrophic loss survivor. He lost his home in a very severe earthquake in the LA area in '94. And since that time has developed a lot of expertise. He happens to be a CPA, so taxes are his specialty, but he also understands the interface between insurance and your financial position and your tax return. So those are the people that make up our team. This is your library for the 2020 Colorado wildfires. We curate this library. We do our best to keep it up to date. And we've done our best to put in it the most useful things from our larger library that are specifically will be helpful to you. So links to sample letters and claim forms that will help you be a good communicator. And then our Colorado professional help directory, where we have professionals in your state that are licensed and experienced in Colorado, as well as information about our upcoming next events. Just a quick reminder that we are here to give you general guidance. We are not creating a professional client relationship with any individual. We're here to educate you. That's me. I'm the executive director of the organization, and I'm a professional insurance consumer advocate. I've been doing that my whole career. And it's been my privilege to serve your beautiful state a number of times after previous fires. And I was fortunate to connect with this woman, Carrie Waite, who is, again, kind of like John. She's in both categories. She went through a loss herself when her home was severely damaged in a wildfire. And then she got very involved in helping her community, and then became part of our team, first as a volunteer and then as staff. And she has had a heavy hand in putting together tonight's information, and has worked with John on previous tax help workshops that we've offered. Here's John. He's one of a kind. He's a CPA licensed in California and Colorado. He, as I told you, himself went through a disaster. He's had 27 years of both advising clients and also training other CPAs on the ins and outs of casualty losses and tax prep for disaster survivors. So you can, he's generous with his time, that I would say. So you can email John or you can call him. Jerry Schreiber just took ill at the last minute, so he will not be with us tonight. But he, if you were on last week's event, you heard him. So John, thank you so much for being with us tonight.
My pleasure.
So our first slide here, what do I need to know now? So I think probably at this point, most people know that the IRS has extended the deadline from April 15th this year to May 17th for filing your return. But even if they hadn't done that, John, is it your general advice, somebody who had lost their home in 6 months previously, that this might not be the time to try to file your return on time, that it makes sense to request an extension?
Well, Amy, in addition to the normal stuff that you got to accumulate to do a regular tax return, there's just so many different pieces that are involved in the reporting for the disaster that it takes a lot of time. And to try to get that done in a short period of time while you're trying to deal with the other aspects of your recovery, and especially now with kids at home doing Zoom classes and everything, and all that other stuff. Yeah, I definitely don't want you to rush through this stuff, because you're going to make major mistakes, and those mistakes could be very, very expensive. So yeah, take your time, and yeah, you want to extend, take the full measure of time that you have to do this. Also, I just in some experiences of stories that I've heard from other people, especially if you're filing a casualty loss claim, it seems that the IRS really notices those early claims that come in, that they figure, oh, this seems to be really soon, right after the fire. They should have taken more time, and they seem to want to go after and audit those really quick.
Interesting. So your general recommendation is definitely get an extension, wait, and then okay. So we're going to get into all these points during tonight's Q&A, and I want to thank those of you who submitted questions in advance. We're going to answer them, and we are going to go over some of the material that we went through last week, just to make sure that it's absolutely clear. So just we talked about the special IRS rules that apply depending on whether or not your disaster has gotten a federal disaster declaration. We did more research after last week's program, so we have a little bit more info to share on that. So we're going to be talking about which proceeds may be taxable, and how what to kind of keep an eye on, so that proceeds that you get from your insurance are not taxable. Just a reminder that second homes have different rules. And that we know a lot of folks out in Grand County lost second homes. So we will touch a little bit on that. And then, of course, we have to emphasize that very core principle of speaking up that we talk about all the time, which is to be very conscientious, even if you're not the kind of person who keeps a journal or is good about keeping receipts. Now's the time to try to change your ways, because documenting all of your expenses and all of the money, your all of your financial matters, either related to your home and your loss, the best way to stay on track and keep forward momentum on the road to recovery is to be organized with your paperwork. So whatever system you got to set up, it's never too late, but it's important to do it. So why file an extension? You already heard John touch on this. And John, would you say in your experience that that it says here it can take several years to know the full extent of possible tax implications? Would you say a year after your loss or 2 years? How do you generally advise your clients in terms of waiting to file their return until they really have the facts and figures clear?
Oh, okay. So first thing, Amy, is you have an obligation to file tax returns every year.
Right.
You may get an extension and go out as far as October 15th, but just because your house burned down doesn't mean that you can wait and not file a return for several years. That is the worst. That's the worst thing that you can do. You want to file the return. Now, if you do not have all of the information related to your situation, related to the loss, then when you file the return, you tell them what you know. And, putting it in colloquial language, at the end you say, and we'll get back to you when we know more. And the reality is that the reporting for disasters, it's like writing a multi-chapter story to the IRS. And each chapter is a year of what happened. And so you need to, you may end up with 4 or 5 chapters, 4 or 5 years of reporting involved in the situation. And so you want to make sure that you report what you know for that year, and then next year you have more information. Some of it may be correction of prior years, and that's okay. Some of it, is going to be new information, like, well, we received another $100,000 in insurance proceeds, or we spent $200,000 on rebuilding our home. That's that year's information that's getting reported.
So I can see people might get confused by this advice. We're saying, when in doubt, file an extension, but we're also saying always, don't miss a filing, right?
Right.
And tell them what you know. So how do you?
Well, the extension is to extend the time to file. So if we're talking about 2020 returns, you want to file an extension May 17th to extend the time to file your 2020 return until October 15th of 2021. But you want to make sure that you file that return by October 15th. And at that point, you want to have as much of the information, or as accurate as the information for 2020 to report in that return. And it's going to be on a supplemental statement. It's not going to be, there's no place, well, if it's a casualty loss claim, that's one thing. But if it's not a casualty loss claim because you've received more than your basis and proceeds, then it's a supplemental statement, because the IRS does not have a form for involuntary conversions.
Okay, so definitely now I feel more clear about what you're saying. So unlikely that filing May 17th is going to be feasible for most people who lost their homes in the fall or who were impacted severely by the fires. but for sure by October of this year, you should be prepared to file a return. So we're just talking about a 6-month delay, correct?
Yeah, and well, 5 month basically, because the normal would be April 15th. But obviously the thing is, you want to take care of your family. You want to process your insurance claim, and you want to the extent possible, you want to make sure that you're starting on the road to rebuilding or buying another house or whatever. So yes, the tax side becomes a little bit of a second child, or I don't even say a second child, a later event, but it does have to get done. But obviously there are higher priorities, but at some point in time, October 15th is a real deadline.
Okay, good. So and then we got a question, does my fire have a presidential federal disaster declaration? How do I figure that out? So we've explained that there are different levels, and currently there is a federal disaster declaration for Grand and Larimer counties. Boulder was not included. And if you want to get more information about this, we've given you 2 links. So, so then is it fair to say that from your digging and Carrie's digging, that we're clear that people who were lost homes in Grand and Larimer counties in the 2020 wildfires do have a presidential federal disaster declaration?
Yes.
Okay, so
And
that's
Amy, you can go to the next 2 slides and John will be able to explain it clearly there.
uh,
I think you're pointing to this one, right?
so
Yes.
so this is a nice illustration, but I think in plain English, it may be better for people to look at this slide. So John, where are the talk to us about what's significant about this, the fact that these 2 counties do have a presidential disaster declaration.
Well, there's Congress and their
You can say wisdom. No, you don't want to say
wisdom. Yeah, I guess. Well, I guess it had trouble coming out.
Yes.
They connected a FEMA designated law with the Internal Revenue Code. And so there's, I can't remember the full name, but I talk about it, refer to it as the Stafford Act. And it's basically an act that authorizes FEMA to designate and do certain things. And there are certain levels of involvement that FEMA may have: fire management, emergency management, fire suppression, and then also major disaster declaration. So FEMA issues numbers with letters in front of them: FM for fire management, DR for major disaster. It is only the DR designated events that then tie into the Internal Revenue Code. And the way the code is written, it basically says if a disaster has been declared, then whatever section that we're talking about in the Internal Revenue Code, that becomes operational. If you don't have the DR, effectively the major disaster declaration, then you don't get to use these code sections. There's a lock on that code section until the DR. And as we're looking at the map here for this designation, the 4581, it's only Larimer and Grand that have been designated, but there's portions of Boulder that were affected. And this is where there's this terrible part of the tie-in, is because the way it's looked at is that presumably the number of properties affected in Boulder were small enough that it's assumed that Boulder County can handle the situation. Now, if we have, I don't know if there's a street in between in any of those counties that border on Boulder, where one side of the street is Boulder and the other side of the street is Larimer, but both sides of the street, their houses were burned down. It's a terrible situation because the people on the Larimer or the Grand side are going to be able to take advantage of tax provisions that the people on the Boulder side are not going to be not going to have the ability to take advantage of. And so these are important things to understand. And with the tax code changes back in 2017, which basically says for 18 through 25, we do not get to claim any kind of casualty loss unless there is a federal disaster declaration. Anybody in Boulder County who would otherwise be able to deduct a casualty loss deduction, they are locked out of that. Whereas the person across the street from them in Larimer County, who is in the same identical situation, can claim that loss. And that's it's an unfortunate thing, and it bothers me a lot. I think about this often.
Yeah, well, it's a lot of this is just numbers, right? There were, simply there's a finite amount of FEMA money to go around. So there are some political decisions that get made. And because the number of homes destroyed in Boulder is less than the number of homes destroyed in those other counties, and because there were other wildfires in other states, that's why this happens. But it's not the end of the world if you are in Boulder and you lost your home. But there are some advantages that will be harder for you to take advantage of. So there's no, John, there's no individual appeal process for, well, my county didn't get the DR, but the people across the street did. But like, if there was a street like that, I don't know if there is a street.
Yeah,
like
I don't know either.
Right.
Well, I mean, the only thing I can say there is that this is a time to write a letter to your congressman.
Congressperson. Okay. So what can you
Yes,
let's just review those benefits. I don't want people in Boulder to get too freaked out that they're going to miss out here, but let's go through the assistance provisions that are available if your county has that DUR. So we've got 5 of them noted here, or 4 of them. So the contents related proceeds related to your primary residence will not be taxed.
Amy, could I just interrupt just for a second?
Yeah.
I don't know, but let's start off by saying that if it's not your primary residence, then it doesn't matter with regard to other than claiming a casualty loss, which may or may not apply. It doesn't matter whether or not you have the major disaster declaration. These special rules only apply, as you're about to say, to your primary residence.
Okay. All right. And so these are so there's that your contents related losses can be added in when you're calculating your deductions for casualty loss. You may have additional time for replacing items. You may be able to amend your prior year's return and claim a casualty loss. So if you were with us last week, you'll hopefully got that when we talk about a casualty loss it has a very special meaning for in the tax context. You all had casualty losses, meaning that you had losses due to a casualty, but we're not talking about that definition of a casualty loss. We're talking about how an IRS definition of a casualty loss. Fair statement, John?
Yes, and you could have a situation where the first key there is that your insurance proceeds, that not only what you have received, but what you expect to receive in total are less than the cost basis of your property. That's the first indication. If they're greater than your cost basis of your property, you don't have a casualty loss, period.
So just to restate it, because I think it is not intuitive. It is not something that people would understand right out of the box. I certainly didn't understand it, but so when we say that whether or not you had a casualty loss, we know you had a loss and it was the result of a casualty, but we're not talking about that. We're talking about whether you have a loss as the IRS determines it, which is, and because of this cost basis issue of what did you pay for the asset, and if your insurance payout was more than what you paid, then by the IRS's definition, you don't have a casualty loss. That's a very grossly oversimplified explanation, but I feel like it's important to say that. Okay, so we're gonna talk more about it as we go through. So you will also, if you've got that DR, then you may you'll have some additional time for replacing items and some extended timelines. You may be able to amend your prior year's return. So let's get to these questions. So do I have a qualified casualty loss? So John, you know, how many casualty losses have you seen in your years of advising?
Well, I would say, and I think my practice probably is a little bit skewed, but I would say overall, maybe 3%. Most 97% of the cases that I've been involved in are not casualty losses. They are classified as involuntary conversion gains.
Okay, so like it wasn't your intention to convert your home into a loss. It was involuntarily converted for you by the fire, is sort of, again, a very grossly simplified way of explaining it. So this is just a Carrie, did you want to explain this chart and what it's meant to convey?
Sure, and it's kind of ironic because we just got a question. I'll use initials from JS asking, can you walk through a hypothetical example, total loss of a casualty loss form 4684, and that's what this chart kind of represents, and in red. And then also, can you take casualty loss without itemizing? And where would you do this on the 1040? So I'm just gonna do a very quick walkthrough of this red pathway, and then John, I'll re-ask that question for you to answer.
Okay.
But, so the disaster event at the top would be the total loss in the example the person wanted answered. And then it's either a qualified or not a qualified DR, federal declared disaster. You could only go on to the casualty loss possibility if it is a DR. There's no way to access a casualty loss form unless it's a DR qualified federal disaster. So assuming that the person asking is in Grand or Larimer County and they have a qualified disaster and they have a total loss and believe that their loss, once it's calculated, is going to qualify as a casualty loss rather than a gain, then they would be able to file that information on form 4684. However, that process to determine whether you actually have a casualty loss is more involved than I'm going to touch on this slide. We will get into that more here, and I'm sure John can elaborate on that. It involves using the cost basis, not market value of your home, and some other concepts that we touched on last time. And before you do that though, John, assuming that you might be able to take a casualty loss, could you do that without itemizing? And if so, how and where on the 1040 would you find that?
I can answer part of that. The answer is yes. If you do not itemize, you can claim the casualty loss. I think most of the software, and I know the professional level software takes care of that automatically. So it's just a matter of filling out the form, if properly filling out the 4684, the loss claim, and then the software will look and say, oh, geez, you're a standard deduction, but oh, you've got a casualty loss, so we're going to give you the casualty loss deduction in addition to the standard deduction. To be honest with you, I have not had one of those situations, so I don't know exactly where. I know it's there. Like I said, the software will take care of it. Hopefully, you're not doing your tax return by hand.
And the process to determine whether you could actually have a casualty loss is rather complicated, and certainly would, the average taxpayer would not be educated in that enough in advance to want to do that sort of willy-nilly on your own and then deal with it later if that was an error. So I'm glad you're attending tonight to get some advice and then perhaps even seek some additional help.
Right, and I don't know if you already shared this, but the person who asked the question about the hypothetical and whether you can take a casualty loss without itemizing does live in an area that got a DR.
Yes.
Okay. All right.
Amy, don't we have a slide with the piece of the 4684?
Yes, I think we have that in there, but here the next slide is on how is cost basis calculated.
Okay, so back to just getting everybody on the same wavelength with the terminology. When we talk about cost basis, we're talking about the purchase cost or inherited cost. In other words, how much you paid to acquire the asset, or what its cost was at the time that it came into your possession, not its market value, real estate value, etc. Right? John, do you want to say anything about inherited cost, or is that going to lead us down a complicated?
Well, if you inherited the home from a relative who passed away, then whatever the fair market value was at the date of death of that person you inherited from becomes your cost basis going forward.
Okay.
One other, I don't think we touched on it really last week, and I just want to touch on it. We talk about the purchase price of the home. Some people buy a lot and then build a house on it. And I just want to point out that the cost basis is the combination of what you paid for personal use real estate is what you paid for the land plus the cost of building that house together.
Okay.
As well as improvements on the land, such as fences and other things like that, right, John?
Fences, adding a room, or I was talking to somebody this morning. They bought a house, they tore out the fireplace, put in a new fireplace. They changed the windows, they changed the doors. That's all improvements. Planting rose bushes, that's an improvement. Fences, a pool, a cabana, everything. The only thing that differentiates that's not included that you're spending money on the house is normal maintenance. So the gardener mowing the lawn every week, that's maintenance. It's not part of your cost basis. Buying petunias, I like to point out, because they are an annual flower, they are not considered an improvement. They're considered maintenance.
Huh. But what if you buy a
rose bush? Rose bush would be because rose bushes are perennials. They last,
So perennials. So if it's going to be there for the long haul, you could consider it an improvement or an upgrade.
Right.
Okay. All right. We did spend quite a bit of time on this last week because it's counterintuitive when people think, well, I'm underinsured, So I had a casualty loss, and we've been trying to explain that in the IRS's view that it's not that simple. And so I don't think we need to really stay too much longer on this. But there are ways to offset and or convert this involuntary gain that you got through your insurance proceeds, where those insurance proceeds exceed what your cost basis was, right? Okay, so anything we need to say about this slide that we haven't already touched on? A qualified personal casualty loss is the lesser of either the cost basis or the decline in fair market value.
So a key, we have the decline in fair market value, what, 2, 3, 4 words there. Those are critical valuations. In other words, you can't just wake up in the morning and say, geez, my house was worth $800,000 before the fire, and now I've just got a lot and it's worth $100,000. You actually need to have documentation showing that, which basically means you need appraisals by a qualified appraiser that has calculated, and theoretically those valuations are seconds apart, because 1 minute you had a house that was quite all right, and then 15-20 minutes later it burned down and all you've got is ash. So it's those two data time points that the valuation is made. So the valuation afterwards does include the fact that the lot is burdened by all that debris, which decreases the value. But there's one little critical thing that the IRS points out is, and they point out that after a major disaster situation, that the whole area has been impacted in terms of its fair market value, and therefore part of that decrease in fair market value is due to what they call temporary buyer resistance. And over time, that will, quote, dissipate according to the IRS, and therefore that portion of the decrease in fair market value is not permitted as part of the loss. So one way to look at that is that you've got a house across the street from you that was untouched, that was worth $700,000 before the fire. They don't have any kind of loss, any claim or anything, but just because they're now sitting across the street from 40 houses that are burned down, the value of their house has gone down because of temporary buyer resistance. People don't want to buy houses in that neighborhood right now, and so effectively that percentage of decrease in their value is that temporary buyer resistance.
Yeah, and we just got a question that makes me it confirms for me that this is definitely not just counterintuitive, but also kind of sort frustrating to people. This casualty loss to the IRS means one thing, and to other people it means something else. So the question is, if your cost basis is lower than what your insurance pays out, but it isn't enough to rebuild what you had, would that be considered a loss? So that's really the essence of people's quandary. It's like, well, okay, maybe my insurance paid me more than the cost basis of my home, but they didn't pay me enough to replace that home. So where does that, how can I how can I use my tax return to tell the IRS, well, sure, I got more money from my insurer than the cost basis of my home, but it wasn't enough to replace the asset. So does that matter?
Yeah, well, to the IRS, it does not matter. They are looking strictly at cost basis and insurance proceeds. They are not a substitute for the insurance company, okay? So they are there to, quote, assist, but they look at this as basically being a sale. So your house was involuntarily sold to the insurance company, and you got what you got. Now if the insurance company paid you less than your cost basis, well, you may have a casualty loss, or you may not have a casualty loss. But the worst situations that I've seen are people who've owned their houses for 30, 40 years. They bought them, when they were, 60% or maybe 80% less costly than they are today. And the insurance just didn't keep up. You bought the house for $100,000 35, 40 years ago, and geez, $300,000 seems like a lot of insurance on that house. But now today it's going to cost you $1 million to rebuild that house. The IRS, all they know is that you had a house that you sold to the insurance company for $350,000. You've got a gain.
Right. So, okay. So that's not to say that there aren't ways of offsetting the tax liability on that sale, right? We're talking about that.
Right.
But it's just important to grasp that basic concept. Okay, what does this form tell us? What is this an example?
This is the whenever I'm meeting with a client, I always start here, because this tells me, one, where are we headed in terms of the kind of reporting. So in this case, we've and I got to get close here to see this. Let's see. Let me move this out of the way here. Amy. Can't get this. So we've got, was it
$421,801 for the cost basis.
right?
And then this person got 103,000.
Yeah, so they're definitely underinsured. Okay, so so we know that, and we most likely have a casualty loss deduction. So now we do go down to the next line 6, and we line 5, and we've got the fair market value before and the fair market value after. And again, these are based upon appraisals, not guesstimates or zestimates or whatever. And so we have a 775 before and 100,000 afterwards. So we have I call it the economic loss. The economic loss is $675,000.
Okay.
So we look at the $675,000. We compare that to our cost basis of 445.
Yep.
421.
421.
We can never have a loss greater than our cost basis. Okay, that's the first rule. So we compare the 675 to the 421. So now we know, okay, we're limited to the 421. That's our loss. And then from the 421, we deduct the insurance proceeds of whatever the $103,000, and that gives us our loss of $318,000.
Right. Okay. So this would be this. So this is an example of a taxpayer who actually did have a casualty loss, as the IRS would define it. Okay. This is that 3% of the people you've met.
Yes.
Example. Okay. All right. In what tax year should I claim a loss? Generally, losses can only be deducted in the year in which the loss occurs, but this can't be known until the claim is settled. So for most people, they don't settle their claim, their insurance claim, sometimes 2 years, sometimes 3. So what does that mean about when you should claim a loss, in what tax year?
Well, back in 2016, the IRS made a change in the regulations, and they came up with they had, actually there was a problem with the way the law was written, and by regulation they came up with a very interesting solution. And so the basic rule in terms of deducting a loss is that in order to claim a loss, not only does it have to have occurred, but it also has to be settled, which means all of your claims, it's not a matter of rebuilding or anything, but in terms of your claims for reimbursement, they have to be all settled. So your insurance is settled. If you've got any outstanding possibilities of legal action or litigation, those have to be resolved. And only at that point do you have a loss. So let's say we've got a 2020 fire like we have here. And let's say that and make it simple that we're just talking about insurance, and that insurance claim is not settled until 2022. And when it's settled, we find out, doing all the calculations, we have a loss. That loss is claimed in 2022. That, for tax purposes, that becomes the disaster year. That's the term that they use, the year that it's settled. Okay. Now, given that in my example that the loss was settled in 2023, now we have an election that we can make, that we can deduct that loss either on our 2023 return, or we can go back and amend and claim that loss on the 2022 return.
Okay.
In terms of making a decision as to which year to do that, that's really there's a lot of number crunching that looks at it to make the decision as to how best to maximize the benefit from the loss deduction.
Okay.
And John, that's going to just depend on the individual circumstances of that taxpayer in those years. Did they make a lot of money? How high is their tax rate? You know, what their personal circumstances were each of those 2 years, right?
Yes. I mean, and sometimes, yes, that's very true. And sometimes the prior year may have a very low taxable income, and maybe you don't get the full benefit in that year, but you also don't get the 10%, the 10% haircut on your loss doesn't affect you as much. And then you claim it there, and then you roll forward and claim the rest of it on the next year's return. So
Yeah.
like I say, there's all kinds, it's not there's not a general rule that I would say that would apply.
So it really depends. And then, as we talked about on the last webinar, it's generally our recommendation that that you not do your own tax return after you've gone through a disaster, and that you work with somebody who has done returns for people who've had losses, but that if you don't have somebody who has that experience, and I think in Colorado there should be a fair number of people who do, John is the man who does trainings, and you can absolutely have your CPA or a CPA that you have either used or would use if you weren't doing your own return, get in touch with John, watch some of his materials, and learn from him. That's kind of his specialty, is helping other CPAs.
I'd like to point out just one last minor part. Let's say at the end of 2020, you've collected all of your insurance proceeds that you're going to collect, except, let's say, for $50,000. And by let's say April of 2021, you've actually collected that $50,000. Then there's actually an example in the regulations that basically say that you can claim that you now have, before you're doing your return for 2020, you have all the information. And even though you collected that last 20,000 in 2021, you could treat that as a 2020 as the disaster year.
Yeah. So, okay, let's keep going. We got another good question, and we have a number of questions, but I want to get through some of these slides. What about land values? The fire caused damage to the land. How is that assessed for tax purposes?
Well, I remember many years ago when I was in Colorado, I was talking to a gentleman that had a property in Black Forest, and his house was totally untouched by the fire, but he had a fairly large piece of property, and in the rear of the property, he had a bunch of trees, and that were valuable trees, and they were burned to the ground. And of course, they are not covered typically by any fire insurance. So now it's a question of calculating what the cost basis of his property is, and then getting appraisals on before and after. So you might have a tree that, I know in my community, we've got an oak tree that's one of the 3 oldest oak trees in Thousand Oaks, probably worth $1 million. But no insurance company is going to insure that for more than $500.
Right.
And if it's a loss, then the question is, well, okay, it might be worth $1 million, but without that tree, what's the decrease in the fair market value of the property? It might only be $50,000. So there's different numbers that get involved here, and it becomes very dicey. Sometimes people will hire somebody who will do an appraisal of what that tree was worth. Well, that's great, but what's the impact on the property as a whole, not just that tree? And that's where it gets dicey on things affecting just landscaping and stuff like that.
Is that when you talk about the integral nature rule, does that come into play here?
Well, the integral nature rule basically is that for personal use real estate, we don't bifurcate the costs and separate the cost of trees versus the cost of land versus the cost of the house. It's just one number. I paid $800,000 for the house. You didn't pay $500,000 for the house and $200,000 for the land and $100,000 for the tree. You just paid $800,000 for the property as a whole.
Oh, sorry. Okay. And then, and obviously, this is back to this question about the land where you had this beautiful piece of land with green and now it's charred, and can the loss from land value be claimed in a future year after the land is reassessed?
Well, we're not in a future year. It's a question of the year that the loss is sustained. And of course, you look at again, going back to that 4684, we had a $775,000 value before and $100,000 value after. Well, let's say that it was just the land that was affected. Let's say that instead of 775, excuse me, 100,000 after, let's say that it went from 775 down to 675, and there was no insurance. Then in that case, we would have a decrease in fair market value of $100,000. The cost basis is still the $400,000 above, and we would have a claim, a casualty loss claim of $100,000.
You would. Okay.
Yeah.
Okay.
Amy,
Yeah.
can I ask a question or two here that have come up that are right in this spot?
Yeah, why don't you, let's take our deep breath here for a second, and then you can come barreling in with those questions.
Okay.
But this is great. We're getting great questions. We got great questions. And it's, so let's all just, okay.
Take a drink of water, John.
Yeah, take a drink of water. I'll take
Yeah. John, you're going to feel like you ran a marathon tonight.
All right, Carrie, I'm going to stay on the deep breath while you ask those two questions.
Okay, thank you. Okay, so the first one I'm going to ask you is an interesting one, and that is in terms of determining cost basis additions or improvements. What if you made major improvements, but you did your own labor? So you just bought the materials and did your own labor. How can you include that labor cost in adding, to your cost basis? Can you claim a market rate per hour for your labor, or is it just the materials that were used?
Do you want the real answer or the sarcastic one?
Both.
The sarcastic one is, if you want to pay taxes on that value, then you might be able to do it. The real answer is that we call that sweat equity. And so, you buy a house. I've done this before, my first house, and I did a lot of improvements, and on the weekends, and I did put that work in. It increased the value of the property, and I got the benefit of that when I went to sell the house. but I didn't add to my cost basis. So, the value of the house goes up. Now, obviously, when you've got a fire, you may or may not get compensated for that increase in that value because of the insurance, because you didn't, the house went up in value, you didn't keep your insurance up in value to correspond, because at that point you thought, well, I only spent $40,000 on materials, so I'll increase the insurance by 40,000. You should have maybe increased it by 60,000.
So assuming that this is an underinsurance situation, which many of these folks are up in the mountains, if this is a situation where the policyholder is dramatically underinsured, would you consider trying to include the labor in?
No,
Or
no.
no?
No.
Okay.
It's not,
Thank
it's just
Not
not
worth it.
includable. No,
Not worth it. Okay.
And then
not
I
question,
think
not worth it. It's just not includable.
I gotcha. And I think I know the answer to this, but I dare not answer it. I'm going to let you answer it. The question is, can you use the cost to remove the trees from your property that were, maybe safety issues and had to be removed in a certain radius around your home? How can you use that cost in your situation? You can't use that as a part of the cost basis improvements, right?
I would include it as part of the cost basis. You've made an improvement to your house. You've made it safer.
Okay, that's cool. I would not have guessed that. So there you go.
All right. Were those the two questions?
Yes.
Okay. All right, great. So we're still, I think we're just going to stay back and forth on the on this concept of whether the IRS views it as a taxable gain, this involuntary conversion, and that there are ways you can reduce that. So Carrie, we got another illustration here. You want to walk us through this?
Sure. This is the other half of the equation. So these are the pathways to scenarios where you would not be able to claim a casualty loss, and you have a disaster event, such as the fire in Grand County or Larimer County, and it is a qualified federal declared DR disaster. That would lead you back into the involuntary conversion gain category if you were insured and are receiving money in lieu of your home having burned, and either from a litigation or from insurance, any of those proceeds would be added in that way. And if it is not a declared disaster, like in Boulder, as you can see in this particular situation, it still leads to the same path in that you still do have an involuntary conversion gain. The next sort of level question is whether it's a primary personal use residence, because if it is not a second home, but a primary home, then that opens up some opportunities to offset your gain that would not otherwise be there. And that's where I'm going to hand it over to John to
Take it away, Johnny. So first thing is that as long as it is a primary personal residence, there is a provision in the tax code that people may be aware of. When in the normal course of selling your house in normal circumstances, if you meet certain qualifications, mostly time, that you can absolutely exclude, forget about up to $500,000 of the gain. Now that provision applies in these situations because remember I said that these are considered by the IRS as dispositions. They're considered sales. You sold the house to the insurance company even though you still have the land, and you can actually use that $500,000 exclusion. And that applies whether or not there's a disaster declaration or not, as long as it's your primary residence. Then the second thing with the primary residence is the benefit is that any money that you receive for contents is just from a tax point of view, assuming that, that you don't have a loss on that, is just totally off the table. You don't have to worry about it. You can spend that money however you want. You don't have to buy any replacement property with that. It's yours to use however you want. The last thing is that the requirement, the replacement period, instead of being 2 years after the first year in which you realize a gain, it's 4 years. So you get an extra 2 years. Now, if it's not your primary residence and you're limited by that 2-year requirement, and it's just, you're not making it. I mean, I've got a bunch of clients that just because of the COVID virus last year, they weren't able to get permits. The building department was closed. I went to the IRS and I got an extension of time. The IRS is fairly reasonable with providing those extensions. One, you have to ask for it timely, and two, they only give them out 1 year at a time. I think that covers everything there, Terry.
Well, pretty much. I think we can kind of move on.
Okay.
All right. This is just another illustration of involuntary conversion, and where the cost basis of the house was lower than what the person collected in insurance, and so they had that involuntary conversion gain, which is so very common. We did get a question. I'm not sure, Carrie, I think this might fit here. The question, can I adjust my 1996 cost dollars up to 2020 dollars? That is, adjust for inflation and local construction costs.
No,
Okay. Well,
sorry.
Okay, that's fine. All right. If I have a gain, can I defer it? So we've been talking about this, and it is possible to defer a gain if you reinvest in rebuilding the home or acquire a replacement home within 4 years. That's what you were just talking about. Is there anything more, or 2 years if you don't have that DR for folks in Boulder? So anything more we want to say about this slide?
Well, again, I want to emphasize that the 2-year and the 4-year period don't start necessarily in the year of the disaster. They start in the year, at the end of the year in which you first realize a gain. So I've got a client who lost his home in a 2017 fire. And as of the end of 2020, he had not received insurance proceeds greater than his cost basis. So he still was not in a position where that 4-year clock starts.
Okay. The one other thing that I think we hit on it in a couple of other slides, here it is right here, is just the point that, first of all, the 500,000 maximum that you can use in this involuntary conversion gain on a primary personal use residence is for a married couple. If you are an individual, then it's 250,000 is the amount. And then, you know, John, this slide's talking too about some of the other conditions, like the fact that you must have been in that personal use residence 2 out of the last 5 years.
Yes and no. Yes and no.
But there is a pro rata, right, John?
Yeah. So let's say that exactly 1 year before the fire, you moved into a new home, and now it's been lost in this fire, and you do have a gain. And let's say that you're a married couple, and you've got a gain of $700,000. Well, that $500,000, you actually have earned 50% of it because you were there for 1 year out of the 2-year required time period. So 50% of the 500,000, we can use 250,000. And once you use that 250,000, that's an exclusion. It literally comes off the top. It excludes from the gross proceeds. So you might have a situation where your gain is is $200,000 and you're entitled to the 250, well, you deduct the 200 out of the 250 and you have not realized a gain. And the important thing there is that 4-year clock still has not started, even though you received $200,000 more than your cost basis.
And then what if to take that example one step further, so let's say you've been in the house a year at the time of the fire. What if it's another year before you receive that gain? Will you have met the 2-year?
No. Think of it.
It's 2 out of 5.
Yeah, well, it's two of the last 5. So I've got a client who was working out of the country, and it turned out that at the time of the fire, he had lived out of the country more than 4 years, more than 3 years. And so it turned out that out of that 5-year period, he had met the pro rata or a portion of that 2-year requirement at the beginning of the 5 years, not at the end of the 5 years. So we got to use, I think it was like $389,000, if I remember correctly, of his $500,000 exclusion.
Okay.
So you might need a little help figuring that one out if you're in one of those circumstances.
Well, also there's other little things, and it's basically, in terms of the 5-year period, it's 730 days with 365 times 2. So,
Oh my goodness.
Well,
Yeah.
I say that because you may have lived there for a year and then you left for 3 years and then you came back and lived there some more time. So over the 5-year period, you were there seriously as your primary residence for 731 days. That's okay.
Okay.
All right. So we know that most of our questions are related to how do I avoid this conversion gain? So here's another question about that. Can I buy multiple properties to offset an involuntary conversion gain?
Yes.
Okay.
The only thing is they have to be personal use real estate.
Okay. Like, give me an example, John. Like, let's say it says here, can I buy multiple properties? So could I buy a primary home and a secondary home?
Well, I've got one client who went out and bought a house outside of Reno, and he has been going skiing every day that there's snow, and he hasn't decided as to whether or not he's going to rebuild on the house that was lost down in the hills of Sonoma County or not, but he could rebuild that house and have the second home up in the forest. It doesn't have to be a primary residence. It just has to be personal use real estate.
Okay, personal use. So buying an investment property
Does not count.
is not going to cut it. Okay.
Right.
All right.
But
And we're not going to talk about Airbnb, buying something that you sometimes rent out on Airbnb. Maybe that's like I didn't hear you on that, but I mean, right? Okay. Carrie, did you want to say something?
Yeah, there's another good question here. Is it only the dwelling coverage limit that's used to offset the cost basis, or are the other buckets of coverage and dollars you receive from things like debris removal, law and ordinance, extended replacement cost coverage, and landscaping? All those dollars that you receive, are those included in the replacement? I mean, in the money, the gain, I guess.
In the calculation, yes, they are included. And here's one of the tricky things, and I see all the time, and that's that FEMA comes in and says, we'll clean off your lot, and then they go to the insurance company and they say, okay, how much did the people have for coverage for debris removal? And the insurance company says, well, they had $100,000. FEMA says, we'll take it. And sometimes they make money on that, sometimes they don't. But the FEMA is limited to that $100,000 of coverage. And what happens there is, the way it's treated is the taxpayer has received $100,000 in proceeds, and then they have invested $100,000 back into the post-fire property value, increasing the property value cost basis by that $100,000. Now, in other situations where I've seen, matter of fact, I was talking to a client this morning, same client, they had $40,000 worth of debris removal. They got a bill from FEMA for $100,000. They actually spent of their own money $30,000. So as far as I'm aware, the only thing that FEMA can collect from them is the difference between the $40,000 of coverage and the $30,000 that they themselves spent. So that FEMA's only going to collect from them, actually from their insurance company, $10,000.
Okay,
And
so I came back to this slide. Well, I'm sorry, Carrie, did you have a follow-up on that specific?
Well, I was just going to say, I'm not aware of FEMA doing much in the way of debris removal in Colorado. I haven't heard of that. I'd be curious if that's happening, if anybody wants to tell us on the chat that happened to them. But so far, I think that's been something kind of unique to California in these very big fires.
Sorry for mentioning it.
No, it's all good.
Okay. That's all right. So I came back to this slide just because I think people have a lot of still questions about offsetting an involuntary conversion gain. And one of the questions that came in was, is the only insurance proceeds that matter for determining whether you had this involuntary conversion gain, your dwelling limits, your coverage A, is that all that matters for purposes of determining insurance proceeds, or do you lump in, do you have to report what you collected for dwelling and other structures and contents and trees, shrubs, landscaping, etc.?
Okay, so let's look. We've got, generally speaking, we've got 4 coverages: A, B, C, and D.
Right.
A being the primary, the primary coverage for the real property. B being something called secondary structures, or the only place I've ever seen it is in an insurance policy, appurtenant structures.
Right.
Then we've got C, contents, and then D, additional living expense. C and D do not go into this calculation.
Okay, so only
but everything in A and B count.
so dwelling and
The dwelling, the
other
debris removal, the trees and landscaping, the extended coverage, the code upgrades, all of that goes in there. Now, and the extended coverage. Now, here's an interesting thing that I've seen just fairly not very often, is sometimes on the contents, in addition to the contents coverage, there is debris removal for the contents. Now, obviously, when you're looking out at your lot with just the ash, you can't decipher the difference between the ash for your clothing versus the ash for your structure. It's just ash. But if the insurance company is paying for debris removal related to the contents, that gets treated the same as the contents money, and it becomes not taxable.
It's not taxable. Okay, so we've got your dwelling coverage is included, your other structures, your tree, shrubs, and landscaping, debris removal, but only to the extent that it was removing ash from the structure, if you could distinguish.
Right.
Of course you can. What
And
about
law and ordinance or code upgrades?
what about code upgrade coverage?
Yeah, that's part of it too.
Part of it,
And
and extended coverage?
same
or-
thing.
Okay, so that does count. Those things count. Okay.
It's all related to the structure.
I'm sorry, I'm
Right.
bouncing
Or
on.
it's all related to the real property. Obviously, the trees and landscaping doesn't relate to the structure, but it relates to the real property.
Okay, so I just want to make sure we've covered this, and if we did, you can say we've covered it. A lot of people, especially people who are underinsured, and they're trying to figure out where to get cash to replace their dwelling, and sometimes a spec builder will come along and offer to buy your lot, and that could be really tempting. If I sell my lot, Will the proceeds be taxable? What if I sell it now, or what about if it's years later?
Okay, if it was within your replacement period, and remember that's started on the day of the fire and extends and then a second clock starts at the end of the year you first realize a gain and goes out another 4 years. So you've got whatever that period is. It might be 5 years, it might be 8 years. As long as you sell the lot within that period, then you can include the net proceeds as part of your overall proceeds and treat it just like any other insurance. Now, here's the other part of this, that let's say you've got your lot and now you've spent $50,000 on debris removal. You sell the lot for $250,000. What ends up getting reported as your proceeds in that case is the net of $200,000. You get to deduct the money that you spent on rehabilitating the lot against those proceeds for the sale of the lot. Now, one other little twist here, and that's that $500,000 exclusion.
Yep.
Let's say that on the insurance proceeds alone, that you have not used up your whole $500,000. Let's say that you've only used up $350,000.
Okay.
And now you sell the lot for $200,000. You've still got $150,000 of your 121, section 121 exclusion. If you sell the lot within 2 years after the date of the fire, not the date, not any other, that's the critical date here, is the date of the fire. If you sell the lot within 2 years of that date, then you get to apply the remaining unused section 121 exclusion. If you sell it a day later, then you don't get to count use the remaining 121 exclusion. But if you get insurance proceeds and later after 2 years for, let's say, $300,000, and you've still got 121 exclusion, you can use it on the insurance proceeds.
Okay.
Sorry to be so precise.
No, I think people want you to be precise. I think that's sort of the point of tonight's precision. I mean, of course, people are looking for whatever nuggets of wisdom you can, throw out on, okay, just tell me what to do. All right. So we have covered the sale of a lot. Which payments may be taxable? Just a quick review here. Taxable reimbursements can include unemployment compensation. If you got reimbursed for items you already had collected for from some other source. So what would be an example of that, John? Would that be like I don't know,
litigation and insurance proceeds for the same purpose, maybe?
Well, keep in mind that litigation proceeds would be added and be treated as additional, the same as insurance proceeds, and added to it. So again, you look at the totals. So it's not a question of did I get reimbursed for this, but what am I getting paid for? It goes into the pot for payment for that item. One of the things that be careful of or be aware of. I remember a client in Boulder with the 2013 floods. She had a townhouse with a basement, and no insurance because it was a flood. She didn't have any flood insurance, but the basement was quite inundated with water. So she was on her own in terms of dealing with that, and we actually came up with a casualty loss. But she told me that a local church had said that if you had incurred this flood loss, if you brought by receipts for expenses that you incurred to rehabilitate your property, that they would reimburse you up to $1,500. Of course, she did that and got $1,500 because the church was reimbursing her based upon her costs to rehabilitate her property. that $1,500 had to be treated as insurance proceeds. If, on the other hand, the church had just, let's say, just knocked on doors, gone down the street, knocked on doors and said, "Oh, did you have any impact from the recent flood?" And she had said, "Oh yeah, my basement's a mess." And they said, "Oh, okay, here's $1,500. No questions asked." That would have been tax-free, a tax-free grant.
Okay, all right. Okay, so,
And so like money, and also money, like an employer sometimes will set up a fund and pay the employees out of that fund. And again, it's usually just a grant. Here, Jim, you had this loss, here's $5,000. That's a grant. It's a gift. It's not taxable. Not reported.
So other payments that are not considered taxable will be ALE funds, additional living expense funds that you get from your insurer that you actually use to pay for your additional living expense. And then charitable, as John was talking about, charitable funds that you get, free meals, etc. So we did make this distinction between ALE funds, temporary additional living expense funds that you get, that you really do use for your rent, as opposed to some insurers that will pay in advance, and so if you haven't used them, they could be taxable. If you haven't used them towards your rent, they could be taxable. Anything else that we want to talk about on this slide?
Well, let's see, we're not dealing with we're not there in terms of using the money for other purposes, right?
No, not yet, but let's get
Separate
there.
slide, separate slide.
Okay. What happens if I buy a home intending
There we
for it to be temporary, but it ends up being my permanent replacement? So talk to us about this, John. The purchase of temporary housing. When does it become the acquisition of a capital asset?
Well, so the problem here is that the concept of additional living expense, there's an emphasis on the word expense. Okay, so expense are things where you spend money and there's no ongoing value to that expenditure. You know, you buy a meal, you eat the meal, you enjoyed it, but there's no continuing expense other than maybe the memory of a fine wine or something like that. But if you buy a house using the ALE money, it doesn't matter whether or not, but usually it's using the ALE money, getting a lump sum and then buying a house, paying the down payment with that money. That's acquisition of a capital asset. Once you move into that house, and I like the way I say it is, tell people you've landed. It may or may not be permanent, but you've landed and you're no longer incurring additional living expense. You own that property. It's yours.
Okay.
So I remember from the 2017 fire, before these people contacted their accountant and I got involved, they got $150,000 in 2017 from their insurance company. The fire was in October. They used most of that money for a down payment on a house in the fire was October. They bought the house in November and they made improvements on the house, and then they moved into it in January. So when they moved into it in January, they landed all of their temporary expenses from the date of the fire through the date that they moved into the house in January. Those were additional living expenses, and they could offset them against that $150,000 that they got. But whatever was remaining became taxable in 2018 when they were no longer incurring additional living expense.
Okay.
Now, the benefit here, I mean, there's obviously the downside that they now have to pay tax on maybe $135,000. But the other side of it is they now have an asset that maybe, hopefully they didn't pay too much for. And it's probably going to take them more than 2 years to make a decision about their permanent home. So they're probably going to get 2 years into that home. They're building the new home, or maybe they're waiting and then they buy. But now they go to sell that house. They've actually put in 2 years in that house. If there's any appreciation, they can use their $500,000 exclusion against the sale of that house.
Nice. Okay.
Okay.
Okay. All
Now,
right.
here's the other thing is that they can also treat that house as part of their replacement property. Okay, so if they have to spend $1.5 million on replacement property, and they bought a house for $600,000, that means they only have to spend another $900,000 on replacement property. And they buy that house, let's say another house that they want to make their permanent house, and they spend $900,000 for that. Now, whatever deferred gain that we have, it gets spread over those two houses, and therefore we spread the gain around, and it reduces any future taxable taxation on any one of individually on those.
Okay. So how is personal property contents treated differently if the home you lost was a second home?
Well, the unfortunate thing there is that now you've got a second loss, independent of the house. You've got a loss on your contents, and that becomes a reportable transaction. And now we get into how do you report that? I mean, you've got I've seen lists as long as 12,000 items of things that people have lost in a fire, and they're making a claim with the insurance company for that. So they're probably coming up with a replacement value. And I would note that when you're talking about replacement value, let's say that you go out and you find out, well, I can replace that couch for $4,000. I don't know what the sales tax rate, Carrie, what's the general sales tax rate in Colorado?
Well, it varies quite a bit, but I'd say maybe 9%.
9%. So, okay, so if you were to buy that couch for $4,000, you're going to pay $360 in sales tax. Your replacement cost is $4,360. Okay, so now that's what you should be claiming from the insurance company, and most likely, if you were to get that, it's substantially more than the fair market value of the couch that you lost. I mean, first of all, you had a couch that maybe you only paid $3,000 for it originally, and by the time the fire hits, it's never, it's kind of like a car you drive off the lot. It's already worth a lot less than what you paid for it. Same with the couch. No matter how much care you gave it, nobody's going to pay you $3,000 for that couch. And so that limits the amount of your possible casualty loss. And if you've got anywhere halfway decent insurance, you probably don't have a casualty loss. But in terms of determining, you also don't know the $2,000, and you may have forgotten about the $2,500 that you paid for the couch. But the one number you do know is that your replacement cost is $4,360. So the IRS says that you can take that amount and depreciate it 10% for every year you owned it. So if you owned it for 5 years, then you'd basically be deducting 50% of the $4,360, or $2,180. That $2,180 would be considered your cost basis for purposes of computing a gain or loss on that item. And so therefore you don't have to worry about finding the receipts and all that stuff. So that there's a little bit of a benefit there in terms of the calculations, but it's still a hairy mess when you're dealing with 12,000 items.
Yeah. All right. We're going to have to kind of blast through here because we're at 90 minutes and we are, and this is important stuff, but I want to make sure that we have answered all the questions that came in. We talked about this on the last one, what if there's a divorce underway? But John,
Yeah.
Talk to us about this.
So,
Actually, pretty common, I'm sorry to say.
yeah, unfortunately, and sometimes the event itself kind of triggers the trauma of the whole thing, triggers the divorce. I can speak from personal experience on that one.
Right.
But in any case, so if the transaction is in process, so
Mhm.
you've got the insurance proceeds, or you're still working on the claim, the IRS basically treats these and uh, what's it called in Colorado? Carrie?
Marital
Marital property.
property.
So if this property qualifies as marital property, meaning generally speaking that that the husband and wife own half of it, well, you get a divorce. The tax attributes, and I'll use that phrase, tax attributes, get split between the two of you also, so that the insurance proceeds are attributed 50% to each. The cost basis is attributed 50% to each. If there's a 121 exclusion, the husband gets his 250 and the wife gets her 250. And therefore, and then they independently, if they have a gain, then they have to go out and buy property sufficient to absorb the proceeds that they got. Now, a planning opportunity here, I've done this once, where the couple were in the process of getting a divorce, and the wife was going to buy a house substantially more than her half, and the husband was going to buy a house substantially less than his half. And so what happened is they stayed married, continued to file joint returns until they both acquired their final properties.
Mhm.
And then we computed the savings that the husband had because the wife's property was absorbing his portion of his uninvested gain. And instead of paying that quasi tax to the IRS and the state, he paid it to his wife. Now she ended up with a house with a lower cost basis going forward because it was absorbing more of the deferred gain. So she was getting a prepayment on the taxes that ultimately she would have to pay. But if she stayed in the house for the rest of her life, it wouldn't make any difference.
Teamwork.
Teamwork.
Um, what if there's a death during the claim?
Oh boy, I've got one of those, and this is really nasty. There are actually 4 court cases that deal with this, and there's one revenue ruling that the IRS has an effect that goes back to 1968. The IRS's position is that the replacement must be done by the taxpayer. Well, if the taxpayer is no longer with us, how is the taxpayer going to replace that property? Now, in the 4 court cases, they basically presented information stating that there was evidence to show that the taxpayer had intended to replace, maybe rebuild or purchase, usually in those 4 court cases, that the taxpayer's intention was to rebuild the property, the home. And the tax court said, you know what, the executor is just fulfilling the wishes of the deceased taxpayer, and therefore they're stepping into the shoes. It gets complicated,
Okay.
but it's the problem is that the IRS has not acquiesced on that ruling.
So you need to use those court cases and argue.
Yeah, which it gets nasty, but there's actually I found a memo that was kind of buried, that the Treasury Department, which is above the IRS, the Treasury Department wrote a memo after the 4th case to the IRS and said, basically, why haven't you gotten rid of this ruling? You lose every time. And nothing's happened.
Okay. So this is really a big issue in California because of the responsibility of the utility of in Northern California for a number of the wildfires, but in Colorado, I don't know that this is really relevant. I'm going to move on from this because I don't think anyone is litigating against the utilities in Colorado. If I'm wrong about that, Carrie, you can write me.
No, I think the only time this comes in, I think John mentioned this last time, is if there is a court case against the insurer, say for underinsurance or something. But
Right. So if somebody has miraculously won an underinsurance case against an insurer, and the proceeds, would those be taxable? It's actually more relevant for what we would call a bad faith case. And you know, for if you lost your home in the fall and your insurer has been jerking you around ever since and acting unreasonably, and you go to a lawyer and they represent you in filing suit against the insurer, and they establish that the insurer was in fact unreasonable, and then you get, let's just take a settlement, because I think the chances of getting an actual judgment, we're talking years. So a settlement in a bad faith case in Colorado, would you want to hazard any observations about that, John?
Well, here's, yeah, this is really complicated, but the thing that you're looking at is, and let's make it simple. Let's say that you're saying on my house, I was underinsured by $500,000. And by the way, because of your bad faith, Mr. Insurance Company, you owe me for damages for bad faith of $500,000.
Right.
And let's say that there's, and your attorney says, oh, and I get a third, so you owe me $500,000 for a total claim of $1.5 million, right? So of course, I tell people there's two things you know about that $1.5 million. One, you're not going to get a penny more than $1.5 million. And two, you're going to get something probably substantially less than $1.5 million. And let's say, to make it simple, that you get, instead of $1.5 million, you get a settlement of $750,000. Well, the way the IRS looks at these is they say, what was your claim? You had 500, 500, and 500. You got 750. So that becomes 250, 250, and 250. So the 250 related, the top related to the property, that's just like any other insurance proceeds. The 250 for the bad faith, now we have to add back to that the pro rata share of the attorney's fees that got you that 250. So that's half of the 250 that went to the attorney. So now we're talking about 375. That 375 is taxable, ordinary income. And yes, you can deduct the 125,000 to the paid pro rata share paid to the attorney, but that would be a miscellaneous itemized deduction. And since beginning of 2018, we no longer have miscellaneous itemized deductions. So there's no place on the return to actually claim it.
Okay, so my general guidance to people on this, being a lawyer, is if you are a plaintiff in a lawsuit and you're going to be getting money in settlement or from a verdict that eventually gets paid, make sure that you consult with a lawyer, a CPA, and your lawyer. Have them work together. If they have any control over the terms of the settlement, that's the way to minimize the tax consequences, is to have the way that the settlement is worded emphasized.
Yeah, I have to interject, because what I've seen is, one, the defendants, well, the IRS, any kind of allocation that's made it that looks kind of fuzzy, the IRS will not appreciate, because they consider the negotiation to be non-adversarial. So they just kind of throw those out. And so you got to be careful on that. It's more what did you claim that the IRS is going to look at. That's what they're going to go back to.
Okay.
Because that's the last adversarial accusation that you made.
Okay. The bottom line is that when it comes to the tax consequences of litigation, settlements and judgments, it's something to get professional advice on. It's been my experience that CPAs are usually very reluctant to give advice off the cuff on that matter. They want to look at all the paperwork okay. We're closing in on the last few slides. This is just a really important reminder about what we mentioned earlier about being organized and being able to track your expenses. We give you a link to a really helpful spreadsheet that you can use free of charge from our website, and really documenting all of your expenses. I think we actually covered this earlier, getting copies of your prior tax returns. I'll leave the slide up here for a minute, and you can just read it. I think we answered most of the questions. We got a couple again towards the end. I want to make sure we answered. Allison asks, to clarify, we can have a casualty loss for a second home generally. And then her follow-up is, do we use our entire property, land and house, to determine cost basis? And
The answer is yes.
okay. Or can we calculate cost basis separately per loss?
No.
Okay, good. And so what about that first part? To clarify, we can have a casualty loss for a second home generally, if you can prove it, right?
Yes.
Okay. All right, good. All right. Do I need or want professional help? Our perspective on this, as a consumer advocacy organization, we never want to see people having to spend money unnecessarily. That's how consumer advocates roll. We want you to get the most for the least. But when it comes to getting professional help on your tax return after you've gone through a disaster, that's one of these areas where we're not a big DIY proponent. We don't suggest, even if you have always done your tax returns, we would say, even so, if you've absorbed every bit of information that we've given you and that John makes available free of charge on his website and our website, and you feel like you're good, I would never say don't do it. But for those of you who don't do your own returns, definitely not the time to do it yourself. And you can hear by talking to John and listening to John that there's some play here, and that having a CPA that really knows the lay of the land with a casualty loss versus an involuntary gain is going to make a big dollar difference for you. So tap somebody who knows what they're talking about and who's done returns for wildfire survivors. If you can't find one, then go through John. But that is kind of a pretty clear line for us based on our experience. And so, Carrie, did we pretty much cover all the questions? I feel like we did, but I want to make absolutely sure.
So I just have a couple that came in kind of late.
Okay.
And most of it got answered actually, but the main one that sticks out to me here, and we kind of touched on it, is, do you have to itemize thousands of personal belongings, or can I use the insurance company's loss summary for it all, home and belongings together? That's around the question around casualty loss.
Well, the home and the contents are separate losses. Okay. And if it's your primary residence, unless you're terribly underinsured on the residence, it's really tough to get a casualty loss on the contents.
Right. I'm pretty sure that's the intent here. And another point with that, John, that I know you made before was even if you, there's a way that you can take your loss from contents and use that in your filing, correct?
I'm not sure what you're saying.
Okay, I'll just leave that one on the table because
Okay.
I don't have the details.
Okay.
Thank you.
All right. Again, I want to, for those of you who haven't been looking at the chat, we've been posting links in the chat. So you want to take a look at that before we wrap up. But we will be making this recording available and the slides available after tonight's event. You can see the upcoming additional roadmap to recovery events that we are offering for Colorado. We've got restoring a wildfire damaged standing home on April 14th. That is for people who were fortunate in not losing their homes, but were unfortunate in having their homes be damaged. The whole unique set of challenges there that we will be addressing on April 14th. And that's going to feature 2 members of our staff that have a lot of experience with partial losses. We've got a survivor to survivor forum coming up on April 20th. And that is, as I mentioned earlier, it's kind of an opportunity for you to bounce ideas off of other survivors about things that you're thinking about doing based on what you've been learning through us or based on what you've been thinking about on your own in terms of, some of the things John talked about, of offsetting your involuntary conversion gain. And then we will also have, so those are the 2 that are most relevant for Colorado folks. So that's what we've got coming up. I cannot thank you enough, John. You are a gem. You're one of a kind. I know you're trying to replicate yourself by training other CPAs, and that's much appreciated. Everybody who asked a question, I hope that we answered it. If we didn't, you are welcome to email info@uphelp.org with your question. And again, I encourage everyone to please use the library that we curated for you. I want to thank our funders, the Community Foundation of Boulder County, the Grand Foundation, the Grand County Wildfire Emergency Fund, the Center for Disaster Philanthropy, and all of you for your time. You're the participants, and then our county partners, really making a big difference in giving all of you who are navigating this strange journey as much support and good, accurate information as we can bring together for you. So thank you for your time and attention, John, again, for your expertise, Carrie, for your hard work, Valerie, Carolyn, and all of you have a safe evening. Be well, we're rooting for you, and we will see you again soon. Thank you so much.
Thank you, Amy. Thanks.
Thank you.
John.